Hey, welcome back to another case study of one of our CEO Finance Academy clients. In this case, we're going to be going through a restaurant owner, actually our franchise owner. They have 3 locations in the Illinois, Chicago suburbs area. We're going to talk through what were the problems they were facing when they came to us at CEO Finance Academy, what did we help them implement, and then what are the impacts long-term of those changes and how we're going to be able to help them continue to grow and scale more profitably. So let's get into the case study. This was, again, a restaurant franchise in the Illinois area. The team consisted of managers, hourly staff, centralized bookkeeping support. We're going to go through this where the bookkeeping support actually was provided by the franchisor, and how some of that actually created problems for the owner to see things at the owner level. So, systems they were using, multiple QuickBook files, Revel POS, OLO online ordering, and third-party delivery platforms. Let's get into the problems that they were facing before working with us. So a couple of things that came up that were really important right away, which was no consolidated financial view. So each location had its own QuickBooks, and none of them were actually controlled by the owner. So it's great that each location had their own QuickBooks account. However, the owner actually didn't have admin access and super admin access to be able to control all of the QuickBook accounts and be able to actually get in there and change things. So there's no way to see total cash, total debt, or combined profitability of all 3 locations. So he's able to see things on an individual level, but obviously as he's running all 3, you want to be able to see things at an aggregate level as well, and he didn't have visibility on that. So problem 2, a big piece of this was it was corporate first bookkeeping, so coming from the franchisor, and owner last clarity, meaning that the owner just didn't have the visibility that was needed to be able to make better financial decisions. The bookkeeping was all oriented and designed to help the franchisor and not necessarily help the owner see the nitty-gritty of where they might need to make changes on their individual location level. So expenses were lumped together, hiding true margin per location. So that created margin confusion and staffing pressure. So what does that mean? Well, the gross margin appeared inconsistent and reliable. I'll share here, actually it was really interesting as we were able to go through this. Our fractional CFO team was able to help see that they were thinking that their operating gross margin was around the low 40%. We were actually able to do this at an aggregate level and figure out it was actually above 50%. Now, I know that might not sound huge, but a 10% margin change in a restaurant type of business that has historically low margins in general, that's massive. Being able to help them get actually clear on what the actual gross margin was on a global level over the 3 locations made a huge difference in terms of where we can actually reinvest some of those profits. So we had chronic understaffing made labor control difficult without clear financial guardrails. We'll get into that here in just a little bit too, of kind of the downstream impact of that. So what did we implement? The very first thing was we consolidated a P&L framework. So we built a single consolidated financial view across all 3 locations. If you're familiar with us, you'll see our dashboard process. We created a dashboard at the global level to be able to see what were, what are the financials across all 3 locations into one specific dashboard. Then we rolled revenue and costs into standardized categories to compare performance apples to apples. So being able to put things into specific categories and standardizing them, so that way we can see and look at, hey, revenue at one location versus another, and then costs at one location versus another. Which ones are actually performing the best and the worst? Which led us to location level margin analysis. So this is B here, where we were able to isolate the gross margin by store to identify which location was dragging overall results. And I don't have this in here, but we were actually able to determine there was one location that was really dragging down profitability of his overall, global 3 franchise location business. Allows us to really make some decision on the staffing side of, is it worth continuing to invest back into that location? Do we need to make changes to that location? And that gave us deep insights into, this is why it feels like cash is tighter, because we have one location that's bringing things down. So we were able to flag costs and labor discrepancies that were previously invisible as well. So let's go through. We also did bookkeeping and categorization cleanup. So we remapped expenses out of misclassified payroll and supply accounts, distinguished true COGS, which is huge, and operating expenses for accurate gross margin reporting. So imagine if you're trying to run a business, especially a restaurant, you don't know your cost of goods sold. In this case, your food costing down to the T. You are very likely to make some mistakes in terms of maximizing profit. So we did a baseline expense model, so we were able to calculate monthly fixed operating costs across all 3 locations, and we used this baseline to understand minimum sales needed to stay profitable. So we were able to talk to the team, be able to tell the team, hey, what are the minimum sales that we need to do on a daily, weekly, or monthly basis to be profitable. And then we did cash and debt visibility resets. So we clarified owner loans, reimbursements, escrow funds, and intercompany transfers, created a simple framework to understand what the business actually owes and owns. So we're able to help the owner see, hey, what do you actually owe? What do you actually own? And be able to make decisions from that. So with the financial clarity, like what's now possible for this? So baseline, this company does around close to $3 million a year in annual revenue across 3 locations. Now that we have true understanding of our margins and being able to recover the actual gross margins that we have, over the next year, what we're really looking at here is, can we identify 2 to 3 points that can change our gross margin per location or across all locations? And that can have a massive impact of 60 to 100,000 a year in terms of additional profitability. Labor discipline. So what we've been able to do with this, especially by isolating cost per location and profitability per location, we're going to be able to set better staffing targets to reduce over or understaffing, which obviously is going to lead to savings by not overhiring at the wrong time or underhiring at the wrong time too. And then decision confidence. So owner now has monthly clarity instead of guesswork. Just giving peace of mind, feeling calm and understanding, hey, I feel like I am empowered to know where to make the next decision to have a better impact on our profitability. We're kind of hoping over the next year that this will have probably 150 to 250,000 in recovered profit or improved profitability. That's where we're headed and what our goal is with this client over the next 12 months. So client feedback, they said, hey, the reason I joined you guys, this is the whole reason I joined you guys. My P&Ls and balance sheet were being managed by the bookkeeper, but there was no financial clarity for me being the owner. And everything that has been done so far has been in favor of corporate in terms of the bookkeeping side. This was in reference to the bookkeeping. It gives me enough data, but there's no clarity, right? There's no financial clarity. And so being able to work together, he finally feels like he has financial clarity for the first time in running this business. And so what's next? What are we looking at over the next 3, 6, 12 months of working together? We want to layer in recipe level costing for catering and high margin items. We're going to test selective price increases where margin is the weakest. We're going to continue refining labor modeling once departments are separated, and then build reserves before debt acceleration or benefits expansion. So this has been a case study. I know that was a lot of big words coming at you, but this is what we do with clients. This is where we've helped them. This all happened in a 12-week period of being able to get to this level of clarity, using our dashboard systems and being able to really dive into an accounting assessment. One of the first things we do with every client is we do a deep dive accounting assessment. It's done for you. We actually go in, we're reviewing your books, really getting clear on your processes and systems. We'll actually sit and help train your bookkeeper if they need training in terms of how you want your process to be. And then, really diving in on the margin level of, hey, what are the margins of our products and services, and where do we need to drive more attention? So I hope it's helpful. If you run a restaurant or someone who runs a restaurant, please feel free to share this with them. Maybe it'll highlight something for them that they go, oof, yeah, we need to get better clarity on that. So I hope this helps. If you have any questions, you can always check us out at ceofinanceacademy.com.